Hello options traders, welcome back everyone. And I wanted to post a quick video here on dividend risk. And this is an important topic, a little more advanced, but it is something that everybody encounters, and unfortunately most people learn about it the hard way. And they'll say, what's this short stock position doing in my account, and why is the broker saying that I owe dividends? Well, you got caught with dividend risk, and it's a potential anytime that you have short calls in the account. So let's take a look at dividend risk and how you can determine if a position that you have is a potential candidate. First of all, understand that equity options, that is options on stock, are what are called American style. And that just simply means that you can exercise them at any time from the day that you purchase them all the way through the expiration date. I'm not saying it's always a good idea to exercise them early, and in fact, in most cases, it's not. But the point is, you can. On the flip side, you have what are called European style options. Those are mostly with indexes. Of course, they're not going to be paying dividends anyway, but a lot of your indexes are European style. And that means that they may only be exercised at expiration. Now, don't confuse that to mean that you cannot close them. You can always sell these options to close from the day that you buy it through the expiration date. But with a European style option, you cannot exercise it early. But if you're dealing with stock options, they are always American style, and that means there is a potential for dividend risk. So what is dividend risk? Well, I think most of you know that a lot of companies pay dividends. If they do, they're usually paid quarterly. And if a stock is about to pay a dividend, the long call holder might decide to exercise it to get those shares. Why? Because if they want the dividend, they have to own the shares. As a call option owner, you never get the dividend. So what will happen is that in some cases, the person who buys this call might, just before expiration, decide to exercise that call early, get the shares, and therefore capture the dividend. And therefore, it presents a potential risk to anybody who has a short call. It doesn't matter what the strategy is. If it has a short call in it, it has the potential for dividend risk. And what happens there is that if you get assigned on that short call, you will end up with a short stock position and you will owe the dividend. Now, on the other hand, if you own the shares, let's say as part of a covered call, then you might miss the dividend. So that might pose a risk to you as well. Maybe that's part of your strategy that you wanted to collect this dividend and now you're going to miss it. So the whole purpose of this video is to answer one question. Will I be assigned on my short call? How do we figure that out? So for example, let's go back to the covered call strategy that I mentioned before, and let's say that you're long 100 shares of Aetna, ticker AET, and you've sold the October 26, 180 call. And now we're getting close to the time that the stock is about to pay a dividend, and you're wondering, am I likely to be assigned? How do you figure that out? Well, to answer the question, there's a few steps we have to take, and the first thing is to understand about dividend dates. Whenever a company announces a dividend, there's a series of dates that are often released in the news. And the first one is the announcement date. And that's just the date that the company comes out and says, yes, we're going to pay a 50-cent dividend, for example, on this date. They just made the announcement. There's also what's called a payable date. And that's the date that the dividend, if you're eligible for it, will land in your account. There's nothing you need to do. If you've got the shares of stock in your broker's account, the dividend will just automatically show up on the payable date. But there's also what's called a record date, and that is definitely the most important. Everything hinges on the record date. Because in order to be eligible for the dividend, you must be owner of those shares on the record date. And a lot of traders don't understand this, but there's what's called a transfer agent that's in charge of keeping track of everybody who owns these shares. And if your name is on that ledger on the record date, then you are eligible for that next dividend. And if not, you might get the next one if you still own the shares, but you would not get that upcoming one. So it all hinges on the record date. But now it gets even trickier than this, because you can't just buy the shares on the record date. Because in the stock world, we have what's called a T+2 settlement, trade date plus 2. So to land on the record date, to get your name on that ledger, you must buy the shares 2 days prior to the record date. And then finally, there's what's called an ex-dividend date, usually called the X date for short. And this is just a little mathematical brokerage made-up date that they put in here to just remind people that if you buy the shares on this date, you are buying it ex-dividend. In other words, without the dividend. If you buy the shares prior to the X date, you will be eligible for the shares. If you buy them on the X date, you will not. So let's take a look at an example. So here's Aetna, and you can see up here is the announcement date. So Aetna right here made an announcement on 9/28, and they said, yes, we are going to pay this 50-cent dividend. The indicated annual dividend, company pays it quarterly, so they're saying if they continue to make this payment, you are expected to receive $2 at the end of the year. So the announcement was made on 9/28, and then they came out and said the record date, however, is on 10/24. So if you want this next 50-cent dividend, you must be owner of record on 10/24. And that doesn't mean you can buy it on 10/24. Your name must be on the ledger on 10/24. So in order to do that, you must buy the shares prior to 10/23. Right? If you buy them on 10/23, that's the X date. That means you're buying them without the dividend. And that's because 2 days later, you would settle on 10/25 and miss the 10/24 record date. And then finally, we have the payable date. If you happen to get your name on record by 10/24, you are going to receive that dividend in your account on November 1st. Let's take a look at it on an actual calendar here. The record date was 10/24. So this is the most important date. You have to have your name, the owner of record, on 10/24. So in order to do that, when do you need to buy the shares? Well, you would need to buy them on 10/22 or before, because they would settle on 10/24. However, the X date, therefore, must be 10/23. Because notice, if you buy them on 10/23, 2 days later, they would settle on 10/25, and your name is not owner of record. You've purchased the shares without the dividend if you buy them on the X date or later. However, when it comes to options, it's a little bit different because we have a one-day settlement. Now, some brokers will allow you to exercise, in this example, on 10/22, 2 days before the record date. However, most are going to require that the shares are fully settled in the account on this date, and that means you must exercise the previous business day. So in this example, you would actually have to place your exercise instructions on 10/19 or before, but it's generally not a good idea to exercise any earlier than you have to. So the whole point is that in this example, 10/19 is the date that you need to make that decision. Is my position eligible for an early exercise? This is the date we want to make that decision. Let's go over to the E-Trade platform and take a look at how some traders would make this decision. So today is 10/23, so we're going to have to just pretend that we're on 10/19 making this decision. And here's what some traders will do. They'll say, it's paying a 50-cent dividend. And if I exercise my call option early, I must sacrifice the extrinsic value, right? Because the only time I can get that is if I close it, but I can't close it and exercise it. So if I exercise the option, I give up this extrinsic value right here. So it would make sense if I give up, let's say, 20 cents in exchange for a 50-cent dividend, it would make sense for me to exercise it. So they might look down this list and say any calls where we have extrinsic value less than 50 cents might be potential candidates for exercise. So these right here are certainly possible, the 192.5, the 195, and the 197.5. This one right here, the 200 strike, has got 95 cents of extrinsic value. Certainly wouldn't make sense to sacrifice 95 cents to capture a 50-cent dividend. However, there's a little bit of a problem with this methodology because if you exercise this call option, you are giving up your limited downside protection. Remember, a long call has this hockey stick shaped graph, and that means there's only so much you can lose. But if you exercise that call and take on the shares of stock, it changes from this hockey stick shape to this straight line profit and loss graph for a long stock position. You now have unlimited downside potential risk, and you must consider if that's something you want to accept in exchange for a relatively small dividend. But on the other hand, there will be some traders, this falls in line more with professional traders, who are going to say, in order to compare apples to apples, I would like to compare a protected position. So let's say, for example, if I am willing to exercise this 195 call and I give up 19 cents of extrinsic value, theoretically, I could go out and buy the corresponding put, the one with the same strike, and therefore have a synthetic call option. But look what it would cost me. It would cost me almost $1. So it doesn't make a lot of sense for me to sacrifice 15 cents on the call and then have to turn around and pay 99 cents for the put to get that same profile to capture a 50-cent dividend. So most traders would not be willing to exercise the 195 call option early because they recognize the value of the downside protection is greater than the dividend. However, watch what happens as we move to lower strikes. The extrinsic value shrinks. And eventually you'll reach a point like this one right here, this 185 strike, where theoretically you could buy the 185 put for 15 cents. Look over here, you're giving up no extrinsic value, and yet you'd be capturing a 50-cent dividend. You'd have no downside risk compared to the long call that you had, but you'd be ahead by 35 cents. So this absolutely would be a potential candidate for exercise, and therefore anything below here. So back to our question, if you had this 180 call short as part of a covered call, yeah, my guess is that you were going to get assigned on this one. I only got 10 cents of value in the put, no extrinsic value on the call, and yet the person could capture a 50-cent dividend. But now, just for another side note, what would a professional trader, let's say, do down here for this 195 strike? If you were still thinking of exercising this call option early, you would be better off to sell the put. Grab this $1. And when you sell the put, you're going to leg yourself into what's called a synthetic long stock position, which means it behaves exactly the same as the long stock position. So we're not inviting any additional risk, but now I'm capturing 99 cents instead of a 50-cent dividend. And then what I do is I just wait for the expiration date and exercise at that time. So that's a little trick that's used by professional traders where we would actually leg into a synthetic long stock position. But for right now, I just want people to understand a basic methodology for determining which strikes are likely to be exercised. So again, as a recap, it is certainly possible that any of these calls that have less than 50 cents of extrinsic value could be exercised early. Now also keep in mind, anything could be exercised early. Even if it's not a mathematical candidate, somebody might just do it, might be a mistake. So if you really don't want to be assigned, the only thing you can do is to close it out or roll it out to a longer dated option to pile on some more extrinsic value and therefore make it an unattractive deal. But if I'm looking just at the extrinsic value, certainly these two are possibilities. Wouldn't surprise me if you got assigned early on these for the 192.5 and the 195s. But if we dig a little deeper, I think these are kind of suspect. Most people would not exercise these early just because of the value of the put. But definitely once you get into here, into the 185 strikes and below, look over here to the left. You're dealing with zero extrinsic value and you have very little cost in the put. So again, traders could easily buy this put, not sacrifice any extrinsic value, and then capture the 50-cent dividend. So all of these strikes from the 185 down are very likely to get exercised early. So back to our example, if you had the covered call and you were short this 180 call, one of two things you can do. First, either close it out over here by paying the 19.22, or roll it out to a longer dated option, in which case you will put on more extrinsic value. So for example, if we even came out here to the next week, so you can see here at the next week still has zero extrinsic value. I wouldn't roll out to there. What about the November 9s? 180 call, 19 cents of extrinsic value. Wouldn't go out there. And I would just keep going up the line until I could put on about 50 cents of extrinsic value. So for example, maybe this one right here that has 38 days. Now you've got 72 cents of extrinsic value. If you roll out to this option, it's very unlikely that the long call is going to exercise early. If you'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course and strategy lab at optionszz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.